Good morning, everyone, and welcome to today's BetaShares webinar. Today, we're going to focus on generating sustainable income out of your equity portfolio, or in other words, equity income. We're going to be having a conversation today. My name is Cameron Gleeson. I'm Senior Investment Strategist at BetaShares, and I'm joined by Louis Crous, our Chief Investment Officer. Now, just to get the admin out of the way, here is our advisor disclaimer. Advisors only for this webinar, general advice disclaimer. You will receive a copy of this recording and the slides afterwards via email later today or tomorrow, so you can go through that disclaimer in full. And myself and Louis, we're going to have a bit of a conversation, ask a few questions, but we've also left time at the end to take some of your questions. So if you see the widget there shown on screen down the bottom, the GoToWebinars widget, you type in your question there, you press send, and we'll endeavour to get to as many of those as we can. And if not, we'll have someone from the team reach out to you directly. Now, today, I think we want to just outline what we'll cover here today. We want to talk a little bit about the contribution of dividends to the overall Australian equity market total return picture. We'll contrast how you might generate income out of equities versus bonds and cash, which has really become a really topical area. We'll discuss different strategies that you might employ to access equity income. And we'll dig a little bit deeper into strategies that are known as buy right or covered call strategies, because there's a little bit to unpack there. And then we're going to touch on the dividend outlook for the Australian equity market as part of the audience Q&A. Now, I'll start with a fun fact. The ASX Australian Investor Study released this year had some really interesting stats in it. One of those was that just over a third of investors under the age of 50 stated that their main investing goal was to build a sustainable income stream. So income really matters for Australian investors, even those younger investors who are furthest away from retirement. Now, when we think about equity income, we're typically thinking about dividends. That's clearly what people sort of focus on, and that's dividends that you might be holding, you might receive through holding shares directly, or indirectly through holding an ETF or perhaps an unlisted fund. Now, I should say that dividends are not the only way to generate income out of your equity portfolio, as we'll go through in a bit of detail. But dividends do make up a very meaningful component of the overall equity market returns in this country. So second fun fact, if you look at the ASX 200 index level on the 1st of November 2007, you'll see it was just over 6,800 index points, which is pretty much where it is today. So over that 16-year period, you've essentially had no net capital growth. And if it wasn't for dividends, it would be a pretty dire state of affairs, really. Now, it's probably a little bit cherry picking because that's just before the GFC, 16 years ago. But if we look over a 20-year period, we indeed see that the contribution of dividends to the total returns is just over half. So just over half of your total returns for that 20 years has come from dividends, and slightly less than half coming from capital gains. So it's no wonder that Australians love dividends. In Australia, we tend to see that investors display a bit of a home country bias, particularly when it comes to investing for yield, investing in dividends. Louis, perhaps this would be a good time to talk us through the profile of the Australian equity market and how this compares to other global markets.
Yeah, sure, Cam, and good morning, everyone. It is true that there is a home bias when it comes to equity income investing, and for good reason. Dividend yields in Australia are very attractive when compared to other markets, and this is mainly driven by two factors. Firstly, our taxation system allows for the corporate taxes paid by companies to be passed through as franking credits when declaring dividends. These franking credits not only result in higher after-tax income for individuals, but they also aid in the willingness of incentivized company to pay out their dividends from earnings. The second aspect relates to the makeup of our share market. It is dominated by a few large and well-established banks and mining companies, those being in more mature and cyclical industries. They have strong cash flows, and their reinvestment needs for growth is not particularly high, and as a result, they have attractive dividend yields. If we contrast this with a market such as the US, it's mainly made up, dominated by technology companies who tend to rather reinvest their earnings for growth purposes. The tax outcomes there also mean that companies tend to favor share buybacks rather than to pay out cash dividends to their investors. we just look at this slide over here, it showcases just how attractive dividend yields are in Australia. So in the US market, it's represented by the grey line, and Australia, the light orange line. And a significant difference there, in fact, more than double the dividend yield. And that's before even accounting for the benefits of franking credits, which is represented by the dark orange line. And so at the broad market level, franking credits add another approximately 1.5% of effective yield for Australian investors. Didn't show any other markets there, but clearly, even if you compare like Europe or global developed, it's slightly more than the US. US is pretty low, but nothing near close to Australian dividend yields, which are pretty attractive. If we look at, I mentioned the dominance of a few companies, and on the next slide, what the slide shows is the contribution to the overall dividend yield in the market, as represented by the S&P ASX 200. And really here you can see that only 10 companies make up 60% of the total contribution to the overall dividend yield in the market, which is quite remarkable. So whilst the US may have their magnificent 7 in terms of tech performers, it appears that Australia have their magnificent 10 when it comes to dividend yield plays in the market. And as you can see, those names that I mentioned, mainly banking and mining stocks, making up those core companies. Just moving on to this next slide, and again, just adding to the attractiveness from the larger companies. This slide shows the dividend yields as paid out by the largest companies, or top 20, if you like, blue chips, as compared to the broader market, as represented by the S&P ASX 200. And previously they tended to deliver similar sort of dividend yields, but over the last few years, you can just see the relative attractiveness of these larger companies, and currently yielding around 1% more than the broader market.
Yeah, great. So, clearly, we have been quite fortunate to have those sectors overrepresented our market, and they've really underwritten the overall yield picture, the banks and large miners. So it's interesting to sort of see that breakdown, that waterfall chart. But I mean, just looking, more broadly outside of equities, with that hike in cash rates that we've seen over the last sort of 16 odd months, RBA cash rate over 4%, you can earn reasonable rates of return on cash. Say for example, our AAA ETF is earning more than the RBA cash rate. You can earn reasonable rates of return on term deposits. Then within fixed income, we now see that you can get a diversified fixed income exposure with a yield of over 5%, and there's hybrids. So there's all these other alternatives now for yield, when maybe a few years ago, the equity market was really your only source for supersized yield. Louis, how should investors think about the income that they can generate from their equity portfolio, versus these other yield alternatives now?
Yeah, it's a great question, Cam, and one that comes up more and more during conversations. It's certainly a better interest rate environment for those depending on regular cash flows, and that also have lower tolerances for risk, for example, retirees. In addition to this, these asset classes also play a very important role in overall portfolio outcomes. And so from an asset allocation perspective, investors have been adding more fixed income and duration exposure of late, really looking to benefit from their defensive qualities and also the high yields they have on offer these days. But in terms of, there are a couple of other considerations to take into account when deciding whether to source income from these assets, such as cash or fixed income, versus, say, equities. Firstly, while interest rates may be higher in nominal or absolute terms, it may not be enough to compensate for inflation risk over time. So when interest rates are lower than inflation rate, that is what's known as a negative real rate. And this poses a risk to individuals, by way of purchasing power. Now, over time, equities tend to compensate for this inflation risk, and has done so during previous periods of high inflation. I mean, after all, companies at the end of the day do have the ability to start passing through higher costs by way of their own sort of pricing models and services and products. But bearing in mind, the normal caveat applies that equities will be more volatile, and they can also experience larger losses over shorter periods of time. Secondly, over very long periods of time, equities as an asset class also allow for capital growth, which may not be the case for other asset classes such as cash or fixed income. And over time, that difference can be quite meaningful. And why this is important from an income point of view as well is that if you are earning the same yield, but on a growing asset base, then over time, your dollar amount of income also grows. And if I can use a very basic example, a simple example, or one that people may be familiar with it. If you held CBA share back in 1999, you were getting a dividend per share of $1.15. Today, you're getting a dividend per share of $4.50, so almost 4 times as much in dividends, even though the dividend yield is exactly the same today as it was back in 1999. The difference being that back then, the share price was $24, and today, that share price is approximately $100. So in summary, it's important to consider more than just the yield, but also some other factors such as investment timeframes, tolerance for risk, and investment goals as well. And I would say the usual disclaimer applies that investors should really speak to their financial advisors when making these investment decisions.
Of course. Yeah, it is interesting and kind of relevant, that point about equities providing some inflation protection. We indeed have seen over the last couple of years that stocks that have had pricing power have managed to increase margins to compensate for higher costs. So equities do have, in moderately rising inflationary environments, the ability to provide that protection. So all points that are worthy of consideration. So given this backdrop in terms of equity yields and the importance of equity income clearly to Australian investors, I thought it was a good time to run through the various options available for an investor that wants to generate a bit more income out of their equities. So we've got 4 alternatives here. The first one is that an investor can go out and maybe they do their own research. They might look at historic dividend yields, which stocks have previously paid strong dividends, and buy individual shares. And it's likely this approach will lead to higher yield than the broad market. You can pick stocks just on their historic dividend yields alone if you like, but it typically will result in a more concentrated portfolio. And then, of course, you've got one of the key risks that people associate with income investing within equity markets, which is the a dividend trap, as it's known, where a company's earnings come out and they dramatically cut their dividends because obviously their earnings don't allow them to sustain that dividend into the future. And investors who were investing in that company for yield start exiting the stock, and you see large capital losses off the back of that. So you have a lot of that single stock risk, particularly around earnings announcements. So as a result, a lot of people will choose this second option here, which is to invest with a professionally managed equity income focused fund. And I show 3 funds within the BetaShares suite that would be classed as a broad equity income fund there. Typically, you're obviously paying a management fee, but getting a more diversified exposure. Now, I'll just talk generally about these funds without going into too much specifics, but these funds will, they're generally aiming to provide a higher dividend yield, often using forecast dividends as a metric to help select the companies they invest in. They'll often use other metrics that aim to capture how stable a dividend profile might be going forward, such as the ability for a company to grow its dividends over time. Now, a lot of these funds are Australian focused because our market is high yielding. But if investors want to sort of diversify outside of Australia and maybe step beyond, that concentration in the banks and miners that we just talked about, you can look offshore, a global equity income fund. And we have the example here. The third one listed is BetaShares Global Income Leaders ETF. So this is providing you a income-focused exposure to the global equities part of your portfolio, and it's going to give you a bit of global diversity there, which is obviously can be a useful thing. Now, I'll go through the third option there, but just briefly, I did want to touch on the last alternative there with a little little star next to it. You don't necessarily have to look for an equity income focused fund to generate high yield. There are numerous funds that will provide an uplift to the broad market yield without necessarily just focusing on equity income. And an example of that from within the BetaShares suite would be the BetaShares FTSE RAFI Australia 200 ETF. This invests in or tracks an index that holds the 200 largest companies in Australia by their economic footprint. So it doesn't use market capitalization, it uses other inputs. And one of the numerous inputs used to determine the companies held in their weights is the size of their dividends. So as that's part of the overall index construction, we see that the index this fund tracks, it gives you a slightly higher yield than the broad market without necessarily just focusing on dividends. So that's another way of perhaps maintaining a more index aware or more core exposure with a slight uplift. But I'll come back to the third point here, which is these buy, ride or covered call funds. This involves a strategy which have become quite popular in recent times, and they allow for a greater degree of yield enhancement and income diversification. Louis, can you tell us briefly what's meant by a buy right or a covered call, and why investors are finding this sort of strategy appealing?
Yeah, certainly. So with such a strategy, an investor is long a security, such as a share, and then long being you own that share, and at the same time you sell a call option over that share. So how does a call option work? Well, the buyer of a call option has the right, but not the obligation, to buy the share at some point in the future for a particular price, which is known as the strike price. And in exchange for this right, it pays an amount of money up front, which is called the option premium. Now, if the share price ends up higher than the strike price, then the option buyer will exercise his right, and in so doing will lock in a profit, but bearing in mind that he also paid the option premium up front. So that has to be taken into consideration when working out the net profit. If the share price ends up being lower than the strike price, a buyer will not exercise his right, and so will be worse off by that option premium he or she paid up front. Now, what happens if you are the seller of that call option, which is what happens with buy right funds? So in exchange for selling that right to the buyer, you collect that option premium up front as income. If the share price, once again, is lower than the strike price, the option buyer will not exercise his right, and you're better off with that option premium that you collected. There will, of course, be those situations where the share price ends up higher than the strike price, in which case the buyer will exercise his right. Now, importantly, you still keep the upfront option premium that you collected as income, and because you own that share, you also participate in any share price movement up to the level of the strike price. And so with this strategy, one is happy to forego any potential upside participation beyond a certain point, but in exchange for receiving upfront option income. And that is exactly how buy right funds work, where they sell single stock options over individual stock positions, or index options over index tracking exposures. And importantly, these funds are managed in a way that you still accrue all the dividends and franking credits that you would associate with the underlying holdings. The option positions are usually rolled on a monthly basis, so you collect these option premiums on a fairly regular basis also. And I will just mention as a side comment, these stock positions are not actually delivered out in practice, but rather the option positions are closed out at option maturity date. So the economics are still the same, but you avoid all the high turnover associated with buying and selling stocks. I just wanted to mention that in case some people were worried about high turnover within the strategy. So to answer your question, Cam, as to why investors find this strategy appealing, well, it is the fact that in addition to the usual dividend income, you're also adding option premium to the investment, to the funds. And these additional option premiums, they add income diversification, which can help manage against, dividend risk, which sometimes, from time to time, can be, part of a portfolio. The drawback, of course, is that, the performance upside is capped as part of the option program, but this is a choice that investors make as part of their overall equity income consideration. Or they may just be comfortable with that view based on the outlook for the market as well. One other benefit I'd like to highlight is that buy right funds tend to exhibit lower volatility than the market, and that's really as a result of the interplay between the performance of your long position and the valuation of your call options that you sold against them. And it can depend on the strategy to strategy, but for the BetaShares suite of buy right funds, that volatility reduction is around 15% against the market. And lastly, I'll also just add that in the current environment, this overall profile is really resonating very well with investors, and we've seen strong inflows into buy right funds, in particular the US. Investors are clearly very focused on generating sufficient income to keep up with inflation, and the outlook for the equity markets based on current valuations also not particularly strong.
Yeah. I mean, it is interesting that despite the fact that fixed income is now providing more income, there's still very much an interest in generating income out of equities, in particular buy rights, given that environment. So what I thought we might do now is just to really, summarize some of those key points, or show indeed using some of our yield maximizer funds, which is the label we provide for our buy right funds, our yield maximizer funds, how these funds have indeed performed in different markets. And you can see in that simplified chart there on screen, We show just that simplified payoff showing that, typically speaking, you expect a buy right strategy to outperform in a bear market, to outperform in a flat market, but to underperform in a bull market. So we'll sort of illustrate that. But before I do, I'll just recap what the funds are within our suite. We have our BetaShares Australia Top 200 Equity Yield Maximizer Fund. That's YMAX is the ticker code you see there at the end in bold. We also have, so that's Australian equities. We have our BetaShares S&P 500 Yield Maximizer and our BetaShares NASDAQ 100 Yield Maximizer Fund, which is QMAX. So all of these funds take advantage of a diversified approach to investing in the underlying equity portfolio. They all hold that passive, broad diversified portfolio, and they all employ call options to generate that additional yield. And so on screen now, I've got the example of QMAX, which is our NASDAQ 100 Yield Maximizer Fund. And I wanted to show its performance since it launched just over a year ago versus the NASDAQ. Now, as we might remember, the NASDAQ did in fact sell off at the tail end of last year, and we see the performance of the grey line drawing down towards the tail end of 2022, and we can see the performance of QMAX is slightly outperforming it to that point. Now, what's interesting from this point is that we're all very familiar with what happened next. The bull market off the back of whether it's hype or whether it's reality, AI, generative AI, and really strong performance out of the NASDAQ 100. We see there the performance of QMAX. So it has performed positively, and indeed the total returns, if we look over here, sort of still quite positive total returns over the entire period, but it has lagged the broader NASDAQ 100, as you would expect, given that you were giving away some upside. Importantly, you have that reduced volatility, and throughout this period, there are lower drawdowns, for example, in that the end of 2022. So slightly different return profile, but in a very strong bull market, you should not expect that you will keep up with markets there, but you've got those other benefits. To take another example of YMAX, which has had a longer track record, and I thought we could run through this across various parts of the market regime to sort of talk through different stages rather than just a bull market. But to do that, to really sort of isolate out the outperformance and underperformance of YMAX versus the broad market, on the top of this slide, I show here what's known as a relative total return chart. So essentially, it's YMAX's performance divided by the broad market performance. When this orange line is going down, that is showing that YMAX is underperforming the overall market. When it is going up, that is showing that YMAX is outperforming the broad market. Now, directly under that, I have the price return of the ASX 200 over that 5-year period. Now, this I think really highlights the performance of a covered call strategy, and YMAX is one of those. We can see here the periods where that orange line is drawing down are indeed what I describe as bull markets. We saw very strong markets up to really the outbreak of COVID or the spread of COVID outside of China in February 2020. And then again, that recovery stage post-COVID when we saw a very strong rebound in equity markets. And these are the periods where that orange line is underperforming. So as I mentioned before, typically a buy right strategy will underperform in the bull markets. However, if we look at that sell-off due to COVID, that corresponds with that steep peak, or the, if you like, strong outperformance over that very short, sharp sell-off for YMAX, being a covered call strategy, and you're getting that additional income to underwrite your overall return picture. And then finally, if we look at what's happened since really about October 2021, in summary, we've really had a sideways market. And since that point, we can see that grinding higher performance of YMAX, so that positive return of YMAX, or outperformance versus the broad market over that sideways market. So it talks to how a covered call strategy will work in that market. In summary, the overall return is slightly lower than the broad market, slightly lower volatility, and you can't see here, but slightly lower drawdowns. So hopefully that gives you some, I guess, insight using a real life example there. So, if we think about that value proposition of an equity income fund, it is clearly about generating more income, and that's key. But having that diversified approach to generating income in terms of your underlying portfolio is important. having that call writing overlay also reduces your volatility, or does reduce your beta to markets, which for a lot of people, risk-adjusted returns are important. Being able to reduce your volatility while collecting higher income and franking credits is really critical. And if we look at the way that the yield maximizer funds work, if franking credits are applicable, you're obviously going to earn dividends on the underlying stocks, and hopefully you're eligible for franking credits. But it's that last grey bar there, that extra income you earn from that option premium can be really meaningful for the overall return picture. So I think I just wanted to also touch on, I mentioned QOS before. Now, like for a lot of people, the current market, we've seen some of the questions that have come in. People are, somewhat pessimistic in some senses as to the potential for capital growth in the Australian market. And if that's your view, you may well be well suited to, looking at a buy right strategy, given that trade-off of income for potential capital growth. But for others that perhaps want to remain a little bit more index aware, there are other alternatives out there. And I mentioned QOS before, which is, if you're like a core Australian equity fund that has an uplift to yield. I show there the last 12 months yield shown on the right-hand side there, that increase in yield that you're getting from this fund. And you can see that QOS over that same 5-year period is quite similarly tracked the broad markets, indeed slightly outperformed the broad market after fees. So that's just another alternative. It's not going to give you quite the same income pickup as WiMax or equivalent funds. So I'll just I'll pause there, and I just think, let's talk about buy right strategies again. Good time to highlight some of the important drivers for those option premiums that the funds are generating. We know that strike price is important. Obviously, all else equal, the closer to the strike price the current share price is, then when you're writing that call option, the higher the premium is you're going to generate. And then the other big drivers of option premiums are higher market volatility and then higher interest rates. So obviously the higher implied volatility in the market, higher the option premium, but that's obviously given that there's a higher probability the share price will indeed exceed the strike price at maturity of the option. So when that price moves around a lot. So Louis, in terms of BetaShares' suite of buy right funds, can you perhaps, we have a particular way of selecting the strike prices, the way that these funds operate. Can you tell us a little bit more about that process for that option overlay and the rationale?
Yeah, sure, Cam. So within our suite of buy right funds, we select strike prices which are out the money, or called out the money, which means the strike prices are higher than the share price at the time of writing or selling that call option. This also means that investors have some capital upside before the strike price limits any further upside as part of each roll. This is in contrast to what's called at-the-money programs, where the strike price is set to equal the share price at the time of selling that option. So no capital upside as part of each roll for these programs, but you do generate higher option premiums at the same time. Our view is that equity markets do rise over time. After all, it is a growth asset class. And by running an out-the-money option program, it provides a better balance between allowing for some capital growth and generating attractive option premiums at the same time. The other feature relates to how we select that strike price. And instead of selecting it based on a fixed percentage out the money, we actually use the underlying volatility of the asset to select that strike price. Therefore, the more volatile an underlying share or an index is, the further out the money, I mean, the higher that strike price relative to the share price will be, all else being equal. And so in this respect, it's quite dynamic, which we think is quite important. And what it does, it also keeps the probability of going through that strike price more constant. And that is between different assets, but also between different volatility environments. So if you are having periods, and we have had some of those, where there's pretty low volatility in the market, there's calmness, out the money profile is pretty low, so strike prices are closer to the share price, versus times when there's high volatility in the market, in which case our strike prices will be set further out the money on that basis. So if I can just use another practical example recently, so for UMAX and QMAX funds, so UMAX being S&P 500 and QMAX being over the NASDAQ 100, UMAX was set 2.1% out the money, versus NASDAQ, which was set 3.3% out of money. And that's purely because there's a different volatility that applies between these two indices. In this case, NASDAQ was doing sort of 17% volatility and the S&P 500 at 12% volatility.
Yeah, right. So you're able to harvest that volatility, provide a bit more upside, a bit more, yeah, a bit more income. Thanks. So if I'm shared the slide correctly now, I just wanted to talk a little bit about that. You know, the distribution profile for these funds. You know, given we've talked about the yield enhancement that you're getting, and you know, you can see on the slide here that the funds versus broad market indices for those markets. This shows the 12-month yield, including franking credits for WiMax. And this is a very meaningful uplift that we see in that overall income picture for WiMax versus, for example, the broad market plus franking credit yield. You see similar things for UMAX, which is S&P 500 exposure. We know that, you know, US equity markets typically yield about, you know, 1.5% per annum. So being able to generate yield like that out of the US equity markets, obviously very attractive. And QMAX, I think we should expect this to go up even a little bit higher, but we're seeing, you know, quite meaningful yield coming out of what really is an asset that people don't necessarily look at for income, being the NASDAQ. One thing I think is really important to note about the use of these funds is, you know, if you have a particular cash flow need that you need to generate cash flow or income out of your portfolio, and let's just say you need to generate, say 5% is the amount you need for cash flow for your retirement or whatever it might be. The great thing about a fund like WiMax is that you can use this in your portfolio, but reduce the amount of it you need because it is generating indeed around about 11% yield per annum, and then spread your rest of your portfolio across other types of exposures beyond equity income. So you don't need to put, you know, all your eggs in the equity income basket, if you like, to meet your income needs. And that's where I think these can be really powerful tools, is about how much you need to allocate to hit your income. But maybe, Louis, it might be worth touching on this. Most Australian investors, when they think about investing in US equities or indeed the NASDAQ, they think about investing for capital growth. You know, you don't see high dividends from those indices. What do you think is the appeal of QMAX and UMAX from that buy right perspective? Like,
yes, great question, Cam. So you're right. Investors don't really think of the US as, you know, using that for yield purposes. They rather access that from a growth perspective. But what a buy right fund can actually do is utilize or harness that volatility on offer in that market and actually convert that to a higher income profile, you know, by using the options and selling those to generate some premium against that. So it adds a different perspective for that market. And then certainly in terms of investors looking for income, that can be a source of income diversification or just additional choice they may have available. But using that buy right strategy to almost, you know, harness that volatility.
Yeah, it's good. And obviously the fact that we're striking the options out of the money means, as we saw with the QMAX example, you're participating in some upside, some capital growth. It's a combination of the two, which is great. I mean, I'll just I think this is also quite an interesting chart. If we just move on here, I just wanted to show the consistency of WiMax's distributions over time. And you know, BetaShares, we are very focused on investor outcomes, not just the underlying strategy and the fee, but also how we manage distribution profiles. Very important for investors who are income focused. And we can see here on the chart in the light grey, we have the overall net yield or cash yield of the ASX 200. In the dark grey, I've got the running yield of WiMax, the cash yield of WiMax of the fund. That's net of all fees and the like. And then above that, we indeed show the gross yield, so it's including the franking credits on WiMax's distributions. And we can see how incredibly consistent that has remained over a long period of time. I mean, broadly speaking, a yield over 10% for almost the entirety of this fund since inception. One of the really interesting points about a buy right strategy, and if we look at that dip in the dark grey line during COVID, is that the yield on the broad market essentially halved in terms of the dividend yield on the broader ASX 200. But on a relative sense, the yield of WiMax fell by about a third. Now, why is that? Now, obviously, WiMax is subject to a drop in the underlying dividend yield in its portfolio. It can't avoid that. But the consistency of the yield that you can generate from the option premium meant that the overall yield maintained a higher level, or essentially the fall in the overall yield of WiMax was much less. And I think that's also really important in terms of, we talked about that diversification of you, not just relying on dividends, but sourcing other forms of, if you like, risk premia to add to your overall income, and a really strong case for. Great. So I think we've got some time for audience questions here, and I'll just organize myself. I'll pull up the questions box, but we do have a couple that were submitted beforehand. So I'll start there. Louis, one for you. There's talk about an economic slowdown, not just globally, but also here in Australia. What is the outlook for Australian dividends next year?
Yeah, if one's going to look at the next 12 months, I'd say it has to be a combination of bottom-up analysis and also macro factors. So as discussed previously, our market is heavily skewed towards banks and mining stocks. So their dividends will be very meaningful in terms of coming to conclusion on that outlook. The big four banks, they did surprise to the upside in their most recent dividend cycle, but their prices also sold off as the market digested the interest rate margin compression that they saw coming through. So based on that outlook, it's unlikely that we'll see any increases in dividends next year. And as far as the mining stocks are concerned, well, it's still very much a China story there. Mining companies have lowered their dividends quite significantly over the last 12 months, but it's also worth remembering that that's come off a very high base from the year before that. China is at the risk of slowing down further, but it could also surprise to the upside. If they can get past their debt hangover. So far, commodity prices have held up much better than expected, despite China's growth struggles. So moving on to a macro perspective, I mean, the high interest rates and the inflationary conditions that we're seeing is causing a bit of pressure on earnings, and that's coming through via, higher finance costs and wages. However, our Australian economy we expect to remain fairly resilient, and earnings contraction that reflect recessionary conditions is not our base case for the near term. The consensus earnings and dividend forecast for next year is only for a very slight contraction or reduction, so talking about low single digits that's on offer. So again, if investors are worried about, on balance, they think there's a further risk to the downside when it comes to earnings and dividends, and they are focused on equity income, it's worthwhile considering other strategies, as we discussed, to diversify some of that income with the offshore markets or other strategies that we covered as well.
Yeah, so I think that's probably the point is that we shouldn't take the high yield of the Australian equity market that we've had for such a long period for granted, because there is risk there in that yield. And we've been very fortunate in that, like, for example, just post-COVID, when the banks cut their dividends, WA, we managed to keep the iron ore mines running, and we had the miners fill some of the holes of the banks with supersized profits there. So, but there is risk, and obviously you should consider those risks. Got a second question which I'll pose to you, Louis, from Mark. And so Mark says, with no share price growth, so his words, not mine, with no share price growth to retain investor confidence, will dividend payout ratios have to remain high now that they need to compete with cash, term deposits, and hybrids and the like?
Okay, so I think it's true that Australian companies, they are very focused on their dividend profile, and they always look to maintain dividends where possible. There is a strong retail investor base in our market, so the companies are focused on those. We do also have very high payout ratios, and it sort of links to comments I made before about the home bias and franking and the availability of franking credits, etc. But we have seen a contraction in the payout ratio recently. Companies are a little bit more cautious in their outlook. They've given that sort of guidance as well. They're being, conservative when managing their balance sheets. I think from here, basically the impact based on the macro backdrop, the impact on earnings will probably be the main driver of what's going to happen with dividends, and the forecasting around that. So, but having said that, there is some room to obviously increase the payout ratio a little bit, given that it's come off recently. But I think companies will manage their balance sheets fairly conservatively, just given the backdrop that we're in.
Yeah. So next question here, which I'll take from Sun. If a recession happens, companies will cut dividends invariably. How could we navigate such a lose-lose on both growth and income situations? So by growth, I mean, I guess what you're referring to is a drop in the capital value of shares, as well as losing the income. So, really good question. Look, I think the answer to a lot of things in investing is diversification. So, we talked earlier about the risks around dividend traps, and it's sort of akin to what we're talking about here. Diversifying your equity income exposure through a diversified portfolio is the first step. Also we talked about the ability to diversify your income through not just relying on the dividends, but also perhaps harvesting, harvesting the extra income that you can get out of a buy right strategy. That might be another way that you can avoid a drop in your income. And obviously, if it is a recessionary scenario, giving away that upside is really costing you nothing. But it's not just about looking at the income side of your portfolio, particularly if you believe a recession is on the horizon. You should consider your fixed income. Fixed rate bonds can provide a really good ballast, and in fact can be negatively correlated in certain economic conditions to equities, and you can generate good yields there. So diversification within equities, diversification of dividend income, other sources of income, and diversification across asset classes as always. Next question, which I'll take just briefly. Luke asks, Bloomberg predict a 100% likelihood of a recession, US recession, I believe, and the US government agencies predict the probability at mid 20%. Why is the spread so wide, and where do you see the percentage chance of a recession? I'll have a go at answering this because I was just reading Bloomberg's latest. So yeah, you're right. Like late last year, Bloomberg came out and said there was a 100% chance of a US recession. I hadn't seen a percentage probability attached to their most recent outlook of the Bloomberg economics team. I assume they might have pared that back from 100%. Now we've seen a number of large, well-read economists now pivoting from their base case from recession to more of a soft landing scenario. Why do we see such a wide spread of this chances of recession? I guess because like always in markets, we're dealing with unprecedented times, and when all you've got really to use to predict the future is the past, and people saw inflation at a certain level where they felt that we've never seen a reduction in inflation from these highs without high unemployment creating a recession. The precedent was there, and so you do see a spread, and I guess that's what makes the market. I'll probably leave that question there. I've got another question that I thought
I'll also probably just add to that
jump
previous
in.
one. At the end of the day, they're just models that are getting used, and so different inputs give different outputs, I suppose, and depending on what factors they apply different weights to, it can give you a different sort of percentage in terms of the overall output.
Okay, great. So I've got another question, just more a technical question in terms of how we run the funds. Hey guys, how do ETFs deal with any franking credits? So an ETF is just like any other managed fund or managed investment scheme. It essentially will pass these franking credits through to the end investors, and you receive them through your distribution or your tax statement at the end of the year, July each year, which in some senses is really no different to if you hold a share and you get your franking credits that way. So, and obviously the benefit of the franking credits are only realized when you submit your tax return, and they form a tax offset there. So if there's any further questions on that particular point, we can just call up and we can give you further information. One here for you, Louis. What downside risk exists in a buy right strategy?
Yeah, just quickly in the interest of time. So when it comes to buy right strategies, your downside protection is really just limited to the option premiums that you received as in the process of selling those call options. So to that extent, it's normally referred to as just a buffer. So outperforming in down markets just to the extent of that option premium received. There's no outright further protection provided. If you look at those strategies, you're really talking about adding put options in those sort of strategies, but that's going to cost you premium because you have to buy those put options, which can offset almost all, if not all, of the option premiums you receive by selling call options. So it's not yield enhancing. It's a very different strategy by capping upside and the downside versus buy right, which is a yield enhancing one where there is some capping to the upside.
Great. I think that covers it. So we're on we're 20 seconds off 45 minutes. So we'll call time there. We appreciate all of you spending time today with us to go through. I think this is a pretty interesting topic and clearly very, very relevant for a lot of Australians. It's been a really interesting year, 2023. We're nearly at a close. We thank you for all your support and your engagement with BetaShares. We're really here, and if you had any further questions, reach out to the team and we will endeavour to address them. So until next time, we'll call time.